Prop firms are everywhere right now, and they promise that you can trade with $100,000, $500,000, or scale up to $1.5 million at some point. Sounds like a dream, right? Well, it's not actually that easy, is it? So if you've ever tried a prop firm challenge, then you already know how hard it is to pass. In this video, I'm going to break down how prop firms really work, how they make their money, and why so many traders fail evaluations. And what we're going to actually do is have a look at how you can potentially get paid by prop firms and strategies that you can use to make money from their model. So stay tuned, and we're going to cover basically all of that in this video. So here's what we're going to cover in this lesson, basically. Understanding prop firm business models, the rules, and what success requires. We're going to look at modern prop firms versus the original prop firms and how they differ. We're going to look at the smoke and mirrors that most traders seem to miss. The drawdown being your balance, basically, is the main one. Modern prop firm business models, the maths behind their rules, and why they are virtually all the same. When you look at all the prop firms out there, you're going to see that they all have very, very, very similar rules. There's a reason for that. They are a house. They're like a casino. There is an edge in what they do, which means that 95%, more than 95% with most firms, traders fail their evaluations. Or if they do get through to funded, they also lose that funded account. We're going to look at the models, the challenge versus the instant funding models that prop firms offer. We're going to look at the different fee structures and profit splits and how those payouts actually work. We're going to look at the risk and drawdown frameworks that they use. And then we're going to look at success factors, strategies that fit the rule sets. We're going to look at consistency versus aggressiveness and how they will impact your chances of passing evaluations. And we're going to look at planning and understanding what is likely to happen and overcome the psychology of prop trading, which is where 99% of traders fail. So we have a tool that we can use to basically visualize what is going to be happening in your evaluation in your funded accounts. So first of all, let's look at prop firms and what a prop firm is. So prop firm stands for proprietary trading firm. And basically what they are firms that put up money, their own capital, and allow traders with successful track records to use that capital to basically generate revenue for the business. That's how the original prop firms used to work. So in the old days, going back 10, 20 years, there were prop firms in London, New York, and all around the world where you could go and rent a desk for usually somewhere around about £3,000 to £5,000 or dollars a month to access their capital. So you would walk in with your trading statistics from however long you've been trading and say, this is what I do, this is how I trade, and this is the revenue that I've generated. Give me some of your capital and I can generate this for you. They would then look at you and compare you to the guy sitting next to you and say, right, well, your return's nowhere near as good as this guy. Why should we give you a job? And that's basically what a proprietary prop job was in those days. You had to pay to go to work. Okay, so you rent a desk to access capital. Okay, the modern prop firms don't work in that way. Modern prop firms basically are saying to you, give me $100 and we will pretend to give you some money so that you can have a go with a demo account. And literally that is what's happening. You are paying for a demo account. So when you part with your hard-earned cash and give them whatever that amount of money is, what they're doing is giving you a demo account and saying, trade this and see if you can get X target within Y restrictions. Okay, and that's basically what modern prop firms are. So they're more of a game, more of a casino than an actual job. Now, there's smoke and mirrors going on in all of these prop firms that most traders miss. The number one thing that most traders miss is the capital they give you is not what you are trading with. Okay, so we're going to go over and have a look at a couple of prop firms now, just to give you an example of what I mean. So this one here is Take Profit Trader. This is a prop firm that I personally trade with. In my opinion, they're one of the best futures prop firms out there. We're going to look at futures and CFDs and the difference between them in another video. But the futures prop firms, there's quite a lot of them. And the business model normally is you pay a monthly fee, which is nominal, say $80, $100, $150, something like that, to access the account. And basically, you need to pass an evaluation within a set period of time. Now, the particular one we're looking at here, Take Profit Trader, is a 5-day minimum. So you have to trade for 5 minimum days. Okay. You can take your money whenever you want to, as soon as you pass your evaluation and get a funded account. And then there is an immediate withdrawal process. And basically, you can reset these accounts, which is a great feature. When you get funded, if you blow it, you can reset it up to 3 times. Okay. Now, they all have rules. So if we come down here, we're going to look at what the rules are. So in this case, we've got a $50,000 account here, which costs $170 a month. Now, there's discount codes available. You won't pay that. You'll usually pay around about $100. But as you can see here, your profit target is $3,000. And you have what's called an end of day trailing drawdown. And what that means is basically you are not allowed to draw down more than $2,000 in one day. So if you think about it, what you've actually got here is not a $50,000 account. You've got a $2,000 account. And what they're asking you to do is not just double that account. They're asking you to put 150% on that account. Because what they're saying is, here's $2,000. You can't blow that. But we want you to come back with 3,000. How many times have you doubled a trading account? How many times have you done 150% return on a trading account? Probably not many. Now, this is why 95% of traders fail their evaluations. They believe they're trading with $50,000. You're not. You've got 2. Okay. In this case, there's $2,000. You cannot go over that. So your risk has to be proportionate to your drawdown limit that you have. So if we look at 75,000, you can now have 2,500 of drawdown. You are trading a $2,500 account. Same with 100K, you're trading 3K. What they're asking you to do is not just come back with another 3K. They want you to give them back 6K. Okay. So you've got to double this account, right? If you look at another one here, we've got FTMO here. So this is one of the bigger sort of accounts that bigger companies that people have traded with in the past. This is CFDs. And as you can see here, trading period is unlimited. And this is a multi-step rather than being a single step like Top Step, Take Profit Trader here. So the FTMO challenge step 1, you have unlimited days to complete it, but you have to do a minimum of 4. You have a maximum daily loss limit of 500, and this is on a 10,000 account. Okay. And your maximum loss is 1,000. So you are not trading $10,000. You are trading with $1,000. In fact, every day you're actually only trading with $500. And what they want you to give them back is 1,000. Again, they want you to double this maximum daily loss that you can have and make it 1,000. Yeah. Why don't you go and get a normal trading account with a normal broker, put $500 in it, and see if you can double an account up to 1,000. Okay, because that's exactly what these guys are asking you to do. They're not giving you 10,000. They're not giving you 50,000. They're giving you whatever you are allowed to trade with on a daily basis. In this case, $2,500. You've got a maximum there of 5,000, which means you could trade for 2 days and still blow the account. Okay, so that's what you're getting with FTMO. Same thing. Okay, so there is a fee involved. In this case, it's $345. It's a one-off fee to access, not 50,000, but access a total maximum loss of 5,000. So a $5,000 account, but you can have $2,500 loss a day. So your risk has to be proportional to this and to this. Okay, so that's how the prop firms work. They take a fee for giving you a demo account. Okay, and 95% of people fail these evaluations. How do we know these statistics? Well, there's this company called FPFX Tech. Great company. And what they do is they provide the prop trading technology to prop firms. Okay, so as you can see here, there's over 150 prop firms launched with their systems. They've sold over $1 billion in challenges. Okay, $1 billion in challenges. Okay, this is how much money these prop firms are making. Now, they've published a blog post which says that the average payout across all of their customer base is somewhere around about the 7% mark, right? So that means that with this company alone, and there are other prop providers out there, it means that 93% of challenges actually fail. And not just challenges, funded accounts too. Okay, so what's happening here is you are getting an evaluation, and it's either a single step or it's a two-step evaluation, and then you are getting your funded account. Then you have to trade your funded account to a certain point before they will give you a payout. And what this company is saying is there's only 7% of people ever get to that payout. Now that payout is a tiny, 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 tiny amount of what they've made in evaluation fees. Some of the prop firms out there in the past have published figures about their turnovers, and obviously companies have to publish this data. Some of these prop firms are making somewhere around about 10 to 15 million a month just in evaluation fees. Okay, now imagine making $10 million a month and then having to pay out a 7% return to the people that pass evaluations. Now, if you spend $1,000 or let's say $2,000 over the period of 3 months on evaluations, and you keep failing and failing and failing, when you finally pass, what's going to happen is you are going to trade that account up to a certain level, and the first thing you're going to do is you're going to take a payout, which is going to get back the money that you've lost on those evaluations. So the vast majority of that 7% of payouts that actually go out to successful traders who get to funded stage and then hold that account long enough to actually get paid is usually all they've given the company in the first place. So they break even. So these companies are making an absolute fortune on just selling demo accounts. And that is the business model that you are up against when you're taking a proper valuation. So that's their business model. The maths behind their rules and why they are all virtually the same. So basically the way they work is they ask for something which is extremely difficult for 99% of traders to achieve: double an account. Okay, we've already looked at how these evaluations work and what they give you. $100,000 account, they are giving you $3,000 and they're asking you to return $6,000. Okay, so they want you to double whatever they're going to give you and come back and say, hey, I've done it. Now, the only way you are going to turn a $3,000 account into a $6,000 account is by over leveraging. Okay. And we all know that over leveraging tends to blow accounts and cause an awful lot of loss. So the mathematics behind their system is to basically create an environment which forces you to over leverage when you're trading because you want to reach a certain target within a certain period of time. Now, by over leveraging, what's going to happen is you are eventually going to hit a losing streak. And that losing streak, because it's over leveraged, is going to take you beyond this drawdown limit. And that is going to fail the evaluation. We've got some maths and some clever software we can look at in a minute to simulate this over and over again. And I'll show you exactly how this works. But that's basically what the business model is and what you're up against. So the maths behind their rules and why they're all the same is basically to create an edge, which means that the vast majority of trading strategies will always hit a losing run, which triggers that edge, which basically fails the evaluation, either on step 1, on step 2, or once you have become funded. Okay, so there are different models out there that you can take. So personally, the way that I work is I run a combination of these two. So you've got the challenge model and the instant funding model. So some of the firms offer instant funding, some of them don't. Take Profit Trader, for example, they just offer a one-step evaluation. So you pay a fee monthly, and as long as you are trading, basically, you will continue to pay that monthly fee, and you can reset these accounts, obviously, as many times as you want to. And you keep going and going and going until you pass the evaluation. And it's only one step to pass. So you've just got to get that $6,000 target. You've got to do it in 5 days and be consistent with it. So what this consistency rule is you've got to be 50%. One of your days cannot be more than 50% of the total profit that you make on the account. Another firm here, Lucid Trading, they offer something called Lucid Direct. And this is a firm that I trade with Lucid Direct. And what this is instant funding. So what they're saying here is we've got a $50,000 account. If you pay us $318, we will give you that $50,000 account and you are trading it from day one funded, which is fantastic until you look at the rules. Okay. So you have a maximum loss limit of $2,000. So we're not trading a $50,000 account. We're trading a $2,000 account. The end of day drawdown is brilliant, which means that what it does is it locks in the drawdown on your account at $2,000 from your highest point or from the closing point of that day to $2,000. So you're always going to be stepping up as long as you're being profitable. You have the consistency rule of 20%, which means that basically you have to have your biggest day at no more than 20% of the entire profit that you've made, and you've got to hold the account for 8 days. So basically what they're saying here is, here's an evaluation, okay? You've got $2,000. You have to be more consistent than in one where you just do a test, because you haven't got that consistency rule there. And you've got to trade it for 8 days. So all you've got to do is trade for 8 days and get yourself into profit to get a payout, which sounds fantastic. The cost of this is obviously an awful lot more, 3 times the amount, than if you go through the evaluation process. So those are the 2 different types of model. And you've also got the 1-step, 2-step funded model, okay? Now, so there's different ways to get the funding and get the capital. But the fee structures, the profit splits, and the payouts are very, very different on all of them. So the instant funding models, you'll find it a lot more difficult to get paid and a lot more difficult to meet the rules to actually get those payments. Most of these firms have in place a minimum profit once you have a funded account, either a direct funded account or a past funded account, where you have to trade up to a certain amount of capital, usually around about whatever the target was with your evaluation, before they will let you take money out. And what that is then is usually whatever is over that amount. So for example, here, you've got a 6,000 target. Some of the firms will say when you get to 6,000 in profit, you can have everything over that. And you can draw as many times as you like, as long as you keep that 6,000 buffer in there. And their reasoning for that is that you must keep that, because if you have a losing run, you need a buffer so that you don't lose the account. You will get a losing run and you will lose the account at some point, because the mathematics behind it ensure that's going to happen. But those are the different types you've got. The payouts and the profit splits vary dramatically. So you need to read each particular prop firm and read the fine print. Okay. So for example, in here, in Take Profit Trader, I love this company. I use them all the time. You have very, very, very simple rules when you're trading. You have end of day trailing drawdown while you're doing your evaluation. When you get funded, however, the rule changes. The end of day trailing drawdown turns into an intraday trailing drawdown, meaning that if you run your account up by $2,000, don't take profit and let it come back to break even, you fail the funded account, because you've actually gone up by 2,000 and dropped by 2,000. It changes from end of day to intraday. Tiny tweaks make sure the house has a much more advantageous edge over you when you have actual funded money. And this is all the way that it works to make it harder for you to actually get through to that payment stage. And as we saw, around about 7%. Risk and drawdown frameworks that they use, they all have risk frameworks, and they have account managers, basically, which run lots and lots of monitors on all the accounts to ensure that there are certain strategy types that are profitable that are not being run on the accounts. A lot of them restrict bots. Why? Because there's a mechanical edge there that we can prove and we can execute without psychology, making money, which is why we use bots. But they don't allow them because they know that they're more profitable than a human most of the time. So there's lots of things that they have in place to manage their risk, and they have lots of frameworks which monitor individual traders to ensure that they're not hedging, i.e. going long on one account, short on another account to guarantee a profit. There's all sorts of things that you cannot do on prop, which potentially could make you a lot of money. So you've got to be very, 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 very careful with the small print when you read these. Don't want to put you off, because you will get paid if you're a successful trader, but you need to be aware of the rules that you're playing within. Okay, so we're going to look at the prop calculator in the Market Structure Trader members area now, and this basically is a way to do prop evaluations and show you how their edges work. Okay, so the vast majority of people, of prop firms rather, will have a profit target of 8%, and they will usually have a maximum loss limit of somewhere around about 5%. So if we look at this one here, for example, we've got an end of day trailing drawdown here of 3,000 and a target of 6,000 on a 10,000 account. So with that particular account, what we're actually using is a 3% loss limit and a 6% profit target on 100,000, okay? And we can simulate how many trades roughly we will take per day with our strategy. You've got a trailing loss limit here, which will trail up. As you can see, it goes up with the account balance. And we can simulate our risk reward ratio, and our strike rate. The vast majority, again, from statistics published by prop firms and prop suppliers, says that the average strike rate is around about 40% for most successful traders that get through to payment, meaning that you have to make sure that you have a decent risk reward and a decent risk on your trades. Okay, so if we look at something like the take profit trader model, where you have to trade for 5 days, what the majority of people will do is they will attempt to pass that evaluation in 5 trading days. Okay, you can see that this one was a fail because it hit the loss limit. We run the evaluation again. This time we succeeded. Okay, and we passed it here with 1 day to go. Okay, we're going to run it again. There we go. We've got another pass. Run it again. Got another pass, and we can do this as many times as we want to. But what will eventually happen is you will hit a losing streak where you will either not be able to get the strike rate for a period of a week or so because the market conditions are wrong for your strategy, or something will happen to make your strategy fail over a short period of time. And this is where the prop firms get you, okay? So you can't quite get to the risk reward level that you want, or you can't quite get that win rate that is your average. So don't forget, a 40% win rate as an average will have weeks where we're hitting 60s, 70s. It will have weeks when we're hitting 20s and 30s. And this is where the prop firms get you, because they know that there is no way to make a strategy have a 1 win, 1 loss, 1 win, 1 loss, 1 win, 1 loss streak. Okay, you're going to have a winning streak where you get a win after a win after a win after a win for 3 days. You do not lose a trade. Then all of a sudden on day 4 and 5, you lose all of your trades. And then on that Monday, Tuesday, Wednesday next week, you lose 70% of your trades. And then it suddenly comes back. But by then, it's too late, because what it's done is it's made you fail the majority of your evaluations, or in this case, your funded accounts. Your maximum average drawdown went over, but it was 3.16%. We've only got 3 to play with. Okay, so you've got to make sure that your risk is within those frameworks that are set by the prop firms. So do not be fooled into thinking that you should be risking $1,000 per trade, 1% of your account on a 100 grand account. What you're doing, if you're doing that, is you're risking 33% of your available drawdown. Yeah. So your risk on a prop firm with a $3,000 drawdown limit should be no more, ideally, than 5, possibly 10% at a push of that account balance. So what we're looking for is we're looking to get a quick run of successful trades. We're not looking to risk anything based on whatever these numbers are. This is smoke and mirrors. This is not what you have. What you have is $3,000. Okay, so with that $3,000, we can break it down when we're trading. If we risk 0.5% of the 100,000, obviously we're risking $500 a trade. That is still incredibly aggressive. But if we run that batch simulation now, where we had 19 fails, we've now got 10 fails, and 10 of them we have kept. We're still in. If we run it again, we've got 14 fails and 6 that we're still in. Okay, so you can see now that we're suddenly within the drawdown limits, and this is on a really bad losing streak. Okay, we're only winning 30% of our trades. We're getting it wrong 70% of the time. Now, the average is around about 40%. Okay, so if we move that up slightly, and let's say we only go to something like a 1 to 2 risk reward ratio, if we run that, you can see that you're keeping the accounts much, much, much more. You're only failing a few of them. Now, on evaluations, you're not passing any, because we are not aggressive enough to actually get these over the line the vast majority of the time. So what you have to do in the evaluation stage is you have to risk much more per trade and try and get these over the line as quickly as you possibly can. Okay, so here we got 10 evaluations taken. Let's say they cost us $100 each. So we spent $1,000, or sorry, let's put it to 10. We spent $1,000 on a valuation here. We've got 5 funded accounts over the line, okay? Now, in this case, we got 2, then we got 1, okay? And now we've got 3, we've failed 6, one of them is still going. And this is all within 5 days, don't forget. So by just ever so slightly increasing that win rate, we'll suddenly start to pass more of these tests. And if we ever so slightly increase that risk reward ratio, we'll suddenly start to pass more of these tests. So the way to pass and get to a funded stage with a prop firm is not to run one evaluation, it's to run multiple evaluations. Keep as many of them going as you can and use slightly different risk, slightly different strategies on all of them. And by the pure law of mathematics, some of those are going to get over the line. But you have to make sure that you're using the correct risk mechanisms. So if you know your strategies and if you know your win rate, you can use this calculator to basically simulate how many of these you're going to pass. And that gives you the confidence in basically running those strategies long term. And obviously you can adjust all the settings in here, but you can see how tight it is to get over the line when they're only giving you a loss limit of 3%, $3,000. So that is what you're playing with. Okay, so the way to pass evaluations typically is to make sure that risk is very, very low and give yourself the opportunity to have a losing streak. As you can see, they've got losing trades here of around about 5 to 10 trades. Okay, so if you're trading with a $3,000 drawdown, your risk per trade cannot be more than 10%, which is $300 per trade. Okay, more likely you want to be risking somewhere around about $150 per trade, which is 5% of the account. Even that is incredibly aggressive, isn't it, as compared to a normal trading account that we would trade. But as you can see, you are going to get different losing streaks. Now you've got 8. Now you've got 10. So you've lost 10 trades in a row. If you're risking $300 a trade on a $100,000 trading account, that is potentially going to blow the account if they all come in one row. Now, luckily, they didn't all come in one go, and this one we got over the line, which is absolutely brilliant. But what you're going to find is you're going to constantly have these losing streaks, and you have to be able to survive them. So using standard risk, 1.5% I've seen people using on prop firms, is absolutely ludicrous. You're risking 50% of your available drawdown on one individual trade. The chances of you passing, obviously, are high if the strategy meets the market correctly when you start that evaluation. If it doesn't, you're going to fail straight away, aren't you? Okay, so that's basically how these prop firms work. So the strategy has to fit the rule set, not the balance. That's the key takeaway here. So you must make sure that when you're risking based on the maximum drawdown available, not on the account balance. And this is why so many people fail. You think you're getting $100,000 account. You're not. You're getting a tiny proportion of that to be available for you for trading. Consistency versus aggressiveness. Take one account and be aggressive. Take another account and be conservative. Take another account and be somewhere in the middle. One of those is going to play out depending on the market conditions. Don't forget, we cannot control the market. We have a strategy that works in a certain market condition. If the market condition meets our strategy, we will pass the evaluation. If it doesn't, we will fail. The aggressive ones will drop. The conservative ones will survive and potentially have the ability to pass at a later stage. The middle ground will probably go into more drawdown, but recover a lot faster. So you just keep resetting these accounts with different risk profiles on them. One risking 1%, one risking 0.5%, one risking somewhere about 6 or 7 maybe. And make sure that you have the possibility of passing one of those evaluations. Don't forget, we looked at the prop calculator and you can see if you run 10 evaluations just by the pure laws of mathematics, some of those are going to get over the line as long as you're not running them all on the same day with the same strategy, because obviously they will all fail on the same day. Planning and understanding what is likely to happen, overcome the psychology. So this is what I was talking about with the prop evaluation here. Use this tool, use the prop calculator to find what is your sweet spot for the evaluation. So put the exact criteria that you have available into here. So for this top step one, it was 3% and 6%. And look at how many trades you generally tend to take on a day and play around with these settings and see whether or not it's going to be easy or difficult for you to pass with the strategy that you're using. And it may be that you need to adjust your strategy. If you've got a strategy that hardly ever trades, but has a 60% strike rate, and let's say, for example, you only get one trade a day with a 1-to-2 risk reward ratio, yeah, you're going to pass them all the time, aren't you? So it's just about keeping that focus and the psychology under wraps. Most people will overtrade. If you've got a strategy like most of us that is somewhere between, mine is around about 48%. If you've got a strategy around about 1-to-2 risk reward ratio at 48%, I don't trade anywhere near that much. You're going to see that it's difficult to pass the evaluations. This is how I trade my funded accounts, with that style of risk. And I'm constantly making money, but it's difficult to get the evaluations over the line. So when I'm doing evaluations, I am more aggressive and I get those evaluations over the line more often. But look at my failure rate. Very, very low, because I'm not using ridiculous amounts of risk and I have a decent strike rate with a decent risk reward. Okay, so play with this, understand how this affects how you are going to pass and how you are going to fail, and make sure that when you get your funded accounts, this thing drops, because your job when you get a funded account is to keep the funded account and survive in the funded account. You want to be in progress. You do not want to be hitting targets. You want to keep the account so that you can make regular withdrawals from it when the market conditions are right for your strategy. Okay, so that finishes off that lesson. That's the first one, how prop firms work. So hopefully that gives you a really good understanding of what you need to do to achieve payment with prop firms. Okay, use that prop calculator. There is a sort of simplified version, basic calculator here as well that you can use to simulate different runs. But this one is specifically designed for prop. Okay, so go and use that and obviously understand how you can make money in prop. In the next lesson, what we're going to do is we're going to cover the difference between CFDs and futures prop and find out which one is best for you. So if you're watching this on YouTube, there's a link in the description below to come and see the MST Academy and the full course to do with prop trading. And obviously, if you're in the MST Academy, you can go on now and watch the next lesson.